Time for hot picks. Our guest covers the telecom and information sector, and he ranks Rogers as one of his top ideas. He says that telecom giant trading at a discount. Too much bad news has been priced into the stock. We're joined by Vince Valentini, Managing Director of Equity Research at TD Cowen. Vince, thanks very much indeed for joining us. Tell us what you think the market may be missing here with Rogers.
Yeah, thanks for having me, Andrew. Look, Rogers has been our top pick since June. The stock's had a nice 50% bounce off its lows earlier this year, but I see no reason to back off it as our top pick. They still have a lot going for them. I'm not sure the market's totally missing this. A lot of the analysts seem to be on the same page now in terms of thinking Rogers is a good place to be. Mm-hmm. But the key drivers for it are the wireless market is getting better. We've seen 6 straight months now of improvement in the advertised pricing from all 4 of the wireless carriers. So that's going to gradually lead to better ARPU and better wireless revenue for Rogers throughout next year. The second point is they're finally taking some steps to improve their free cash flow. Notably, they took their CapEx guidance down for this year. I think they're signaling that their CapEx will come down even further next year. So more free cash flow means they can pay down debt faster, and more of the enterprise value will transfer to equity holders versus debt holders. And last but not least, you've got the sports. The teams they own just keep increasing in value, and there's a material catalyst coming for this stock next year as they finally make a move to monetize some of their stake in MLSE and the Blue Jays through a sale to new private investors.
Oh, would they try to pull off an IPO of the sports business, do you think?
I don't think that's a 2026 event, Andrew. I think the first step is a material injection of cash from new private investors. They need that cash to pay down debt. It's possible that an IPO or some kind of public listing could happen in 2027, but the initial catalyst of a sale to private investors is good enough for the stock in my mind.
Right. And the company, of course, competes with our parent company, BCE. The dividend yield, about 3.8% right now. Is that likely to rise anytime soon, the dividend, Vince?
No, they took on a lot of debt to buy Shaw Cable a couple of years ago, and They still have to pay that down. Obviously, they've been taking on debt to buy up some of the stakes in the sports teams before they turn around and sell them. So I think we're a good 2 or 3 years away from them having enough cash to raise the dividend. But if you don't mind, that's a great segue to another name, smaller cable name, but one I think should be on people's radars is Cogeco Communications, CCA. And their dividend yield of 6% is actually higher than BCE. It doesn't get as much attention as it should. Their payout ratio is extremely low in the 30 to 40% range, so they could increase that dividend materially going forward if they want to. It actually trades at the 3rd highest free cash flow yield of all the stocks in the TSX, not just the telecom sector. It's a way higher yield than most of its telecom peers. And this is a name that's chugging out really good free cash flow. The free cash flow is going to go up materially next fiscal year as a bunch of rural CapEx projects in Ontario come to an end. And I think the stock is close to 50% undervalued. So that's another one of our top picks, Andrew.
They, in their latest quarter, they reported tough competition in the U.S. market. Will that be an overhang for the stock?
It definitely is. Not everything about Cogeco is pretty, and it can't be for the free cash flow yield to be pushing 18, 19%. There's obviously something bad that investors see. What I think is people have paid too much attention to that. They don't own all of that U.S. business. They have a minority partner in La Caisse. There's also a lot of debt within that U.S. subsidiary. So when we extract the equity value of what Cogeco owns in the U.S., it's only 13% of our target market cap or target price for the name. The vast majority of the value of this company is still their Canadian cable operations, and those are doing quite well.
And finally, Thomson Reuters, of course, a huge contributor to the wealth of Canada's fabulously rich Thomson family, and massive in databases and information vending.
Yeah, look, I think this is one of the premier companies in Canada that Canadians should be proud of. We have this homegrown global leader in a sophisticated technology space. They're basically the leading provider of software and workflow solutions to the legal and tax community in the U.S. and everywhere in the world. The stock has just been hammered recently, which is why it's risen to be one of our top picks. It had been pretty expensive for a long time, and we liked the company but couldn't recommend the stock. But since mid-July, the stock's gone from almost $300 to now about $190. The valuation multiple has come down dramatically. What's happening, Andrew, is a whole bunch of information services and software names are being painted with the same brush that Gen AI and new startup competitors are going to eat their lunch. Mm-hmm. And I think the market has it wrong, that Thomson has a really good moat around their services. They have tremendous scale. They're constantly innovating their products. And I think they can stay one step ahead of those smaller upstart players. And as the market starts to differentiate between the winners and losers in this sort of AI race, I think Thomson by next year, people will realize is an AI winner, and the stock should re-rate back to closer to where it was a few months ago.
Vince, thank you very much indeed for joining us.
Thank you.
Vince Valentini, Managing Director in Equity Research at TD Cowen. And there is a look at his 3 ideas.